About 25 seconds until the market open. We are in Wyoming for the Jackson Fed. Tom will be counting us down. Right now you are seeing a lift of the market ahead of time. About 0.6% gain on the S&P. Seeing the NASDAQ actually outperforming, trying to reverse some of the losses from yesterday. Yields a bit lower as well.
Can we go to a Greenspan moment where Alan Greenspan used to always say, would everybody pay attention to chapter 23 of any basic economic textbook, Begg, Mankiw, whatever. The stock market matters. The stock market's screaming something. I'm not sure what it is, but it's up, up, and away.
Well, it's screaming that maybe it's a reversal of yesterday's dashed hopes about a 50 basis point rate cut. You're seeing yields reverse once again, down about 2 basis points on the 10-year. The 2-year is really what I'm watching today. And frankly, over the past year, down more than 1 percentage point since the last time that we were gathered here at Jackson Hole, at a time when people are really expecting some sort of beginning of a rate cutting cycle. Unclear, though, just how deep that will be and whether gradual means 50 basis points at some point.
And the push, that's really well done about the last 12 months and about the dynamics we've seen. But the push here has been everybody looking for some form of GDP slowdown, NBER recession, not some other vanilla flavor of it. I don't know. It hasn't happened. The heart of the matter is a recession hasn't happened.
Not only hasn't it happened, but the S&P 500 is up 25%, more than 25% since August 26, 2023, when we last heard from Jay Powell. The focus there very much on bringing down inflation. Now we're expecting to hear much more about employment concerns and maintaining a robust labor market, as we do see the unemployment rate tick up about 0.5% from 3.8% at the last time he spoke to the current place of 4.3%.
And the word that everybody uses is solid. And, you know, when you have Loretta Mester coming up, the answer solid doesn't cut it, because the mathematician's going, what in God's name is solid? But there we are. We have a solid economy.
Well,
I don't know what that means.
Well, we'll find out from Loretta Mester, who's sitting us. She is former Cleveland Fed President Loretta Mester. This is the first time that she's joining as a non-Fed member in 10 years at this Jackson Hole meeting. Loretta Mester, President Mester, I will still call you that. You've always been a thought leader. How much do you hear more dissent than usual among members at a time where we really are at a pivot?
I'm not hearing that much dissent, frankly. I think we're in a good place in terms of where the economy is. If you think about inflation, look how much it's come down. You know, we're in the 2.5% range, and the labor market is moderating. There's definite signs of that, but it's not weak. Right? It hasn't turned into a strong, weakness coming into it. So we're in a good spot. And now what the Fed needs to do is make sure that it can maintain the momentum of inflation going all the way back down to 2% while keeping the labor market healthy. And I think that's where the focus is going to be. If you remember at the start of the tightening cycle, we had to go very aggressively because policy wasn't well calibrated to where the economy is and where it was going, or was and where it was going. And now we want to make sure that, the Fed wants to make sure that policy stays well calibrated to the economy. So the discussion now, I think, is about, we have a dual mandate. We have to focus on both parts of that. We have to be forward-looking. It's where the economy is going, not necessarily where it is here today, but where it's going. And that's why I think now it's actually appropriate to really be thinking about, okay, it's time now to enter this new phase where we can start normalizing the policy rate.
Wall Street and the financial media want specificity. They want certitude. They want single-point statements about exactly where we are. The reality is, just to look at productivity, is a capital analysis, a labor analysis, and an all-in analysis. Call it total factor productivity. The noise in there, to me, with the overlay of technology, is highly uncertain. Do you have any handle of the overlay of productivity and technology's effect on the Cleveland and American economy?
Well, I mean, we've seen over history, right, that technology can be very additive to productivity growth, right? I mean, that's kind of the engine of an economy that's increasing and having, potential growth rise. But in any point in time, it's very hard to measure productivity growth. Even if we didn't have this big technological innovation of AI, it's very difficult to measure it. So you have to take into account that there's uncertainty around productivity growth. I mean, some estimates say that we're still in a low productivity regime. Other estimates are saying, let's look forward, maybe we're going to be in a higher. But for the Fed right now, right, that's not sort of the focus. The focus is
Yeah.
are we calibrated well? Is policy calibrated well to the economy?
Mike, you've been great on this. She just said they're not focused on productivity. We have to be, because business leaders every day are focused on those outcomes in their investment.
Well, they've sort of been forced to by inflation and a lack of workers, and they've been forced to put investment into productivity. We'll see if it starts to pay off. But Loretta's right. At the moment, you're not seeing it, but that's not the key for them. But I do want to know how you respond to the criticism that the Fed has not communicated well what it's thinking and what it's planning, or if not planning, what are the potential outcomes? Because we've seen some very wild swings in the markets as data comes around. Have you said data dependent too much?
I think there's a misunderstanding of what data dependent means, and that means that I think Chair Powell today will be explaining where he sees policy going, not necessarily at the next meeting, whether 50-25, which in some sense is really not the big issue. I know for financial markets it is, but not in terms of monetary policy. It's really, what's the path forward? Are we beginning now to bring policy down? And the pace, of course, and the magnitude eventually of how far interest rates go down, that's going to depend on how the economy evolves, right? But we're going to enter this new phase, I think, and appropriately so. In July, I probably wouldn't have supported actually moving the rate down in July, and of course the committee didn't, but I could have made a case for it. And that's a change, right? The economy has changed enough. Inflation has come down quite a bit. It's on a path, I think, where we can be pretty confident it'll get back to 2%. And now we really have to balance both sides of the mandate. So it's basically keep the momentum going on inflation, at the same time making sure that labor markets remain healthy.
What do you think it would take for the committee to decide you needed to do more than the standard 25 basis point cut?
So I think it would have to be that, somehow they thought they were a little behind and they needed to catch up. And frankly, I don't see that in the data. I think they're actually in a very good place. Now, if it turns out that, the forecasts are saying, wow, we may be seeing the moderation in labor markets being more than moderation, and we actually see a weakening, they may have to adjust that and then do more. But I think there's sort of a record. If you think about when we started to raise rates, right, we started at a 25, then a 50, then we did our 75s, and that's sort of the preferred path, because that means you're not doing too much too ahead of time. And the other thing I think I would be worried about is if you do a 50 to start with, the markets then, build in even more. And I think that's a calibration that you have to think about when you're doing this. So I think being steady, right, thinking about what the right pace is, geared to how the economy is working and evolving, is the right way to go.
You said that you expect Jay Powell to come out and give a sense of where we're going. And I think that's actually the frustration for a lot of people in markets. We don't know where we're going. We don't have a sense of what the neutral rate is. Right now, the market has about 200 basis points of rate cuts priced in by the end of next year. Is that appropriate? What is neutral?
Well, remember what the markets are doing is, and appropriately so, looking at different scenarios, right? They're waiting, and then when you get those kind of things out of the financial markets about how many rate cuts, it's balancing different scenarios. When the Fed's talking about, where they're seeing is, they're talking about, here's what we think, if the economy evolves as we expect, would be appropriate policy path. But they also have to think through other alternative scenarios too. So it's kind of a different answer or different answer to a question. And that's, I think, the frustration is that the Fed is trying to answer a different question, is here's where we see policy going. But of course, they don't want to commit themselves to something because the economy could evolve differently. And that's been hard to communicate.
You founded an inflation lab at the Cleveland Fed. What do you think inflation dynamics are now? Is this a completely different kind of situation post-pandemic than models coming out of other recessions have worked with?
Well, I think one thing that we saw during the pandemic and the aftermath was that the supply side, right, had a lot to do with inflation dynamics. But the key thing to remember is that those supply shocks would not have necessarily resulted in higher inflation if we hadn't had a very strong demand side of the economy. So it's this balance between supply and demand. Typically, right, in the past, right, it was all about demand. Supply, you could sort of say, was sort of stable, and it was all about how demand was moving around. In this event, right, it was both supply and demand, and that made it more challenging. And so in that sense, I think there's a renewed understanding that dynamics on inflation, it's both sides, it's supply and demand, and understanding both, I think, is going to be a focus going forward.
Well, as the Fed goes into its review process for its monetary policy framework, does what happened change the way you think the committee should look at policy? In other words, maybe you want to be a little bit more preemptive than you were?
So I know a lot of people characterize the Fed in the framework that came out in 2020 as walking away from being preemptive. But if you actually look at the language in there, still says preemptive. I agree with you that it sounded like we were just being data dependent in the moment, but we always were focused on where is the economy going. So it's data coming in. Assess that data relative to your outlook. If it's materially different than you expect, you might have to change your outlook, and therefore you might have to change policy, your expected policy path. So I think we've always been forward-looking, and I expect the Fed to remain forward-looking. They may change the language in the statement so that that's a little bit more transparent, if you will, so that people actually understand that the policy has to look forward.
I would never ask you this question if you're on the watch, but now that you're gainfully retired and in the real world, I'm going to ask you this question. Cleveland has reasonable real estate, but Shaker Heights has a boom real estate economy. And part of that asset success of Shaker Heights and the Shaker Heights of America is the gains the haves are getting from this financial system. How does the Fed distribute the benefit more across America rather than this illusion that only the have-nots that own the haves that own NVIDIA are making way?
Yeah, I mean, the Fed always focuses on the macroeconomy, right? It doesn't have tools that can really do much about redistributing or fairness or making sure that everyone gains. But what we can do at the Fed, and what the new committee will be doing at the Fed, is making sure that we maintain healthy labor markets, which again helps distribute, and brings inflation and price, the inflation rate down. And getting back to price stability is also very key to having a strong economy so that everyone can prosper from the economy. The Fed really can't do the other part of what you're talking about, and that's what the federal government policies are about and fiscal policy is about.
We thought that you were going to retire and build homes, so that you try to offset some of the supply issues. Loretta, there is this question. Mike was talking about how you're the queen of inflation studies and how the Cleveland Fed really does have an incredible metric for that. Do you have a sense of how much more inflationary this post-pandemic economy is? And that really speaks to what is the new neutral?
Well, there are certain factors that really affect inflation, right? But the basics are similar to what we saw before, right? Inflation expectations are still an important driver of inflation. Making sure they remain stable is helping to keep inflation moving down, which is important. Supply side conditions matter, and labor market tightness matters. We're going to hear a paper at Jackson Hole that's really addressing that, how much tightness in the labor market affects what you might see when demand gets out of whack with supply. So again, right, it's the same basic factors, but of course the supply side during the pandemic changed quite a bit, and those factors are going to become, I think, more significant going forward than perhaps they were in the past.
Are you having more fun now that you're not on the committee?
I'm having fun.
Well, hopefully you can go hiking or enjoy the beautiful Wyoming. Loretta Mester, formerly of the Cleveland Federal Reserve, just going back to the end of June when you stepped down, and she is here for the first time in 10 years, not as a member of the committee, but as a civilian who is planning to do lots of things in her free time. But Tom, to me, this is really the key question that you bring up. How much, and this goes to the core of what the theme of the Fed meeting is, how much is under the Fed's control and how much isn't?
Well, there's a whole theory theory on this, and I thought that Dr. Mester answered it perfectly, in that the Fed has a mandate, a mission, and then you go over to fiscal. But this goes into what the great unspoken is at this meeting. I believe there's a calendar date, November 5th, and no one here is talking about November 5th because that gets to the fiscal debate.
They don't really want to weigh in on something that they don't know.
Anne-Marie Horton is not here. Let's make it clear.
She is definitely in Chicago after yesterday's speech. Coming up next, we've got ECB Governing Council member Mario Centino. He will be joining as we talk about the influence of Fed policy on the rest of the world. Right now in beautiful Jackson Hole, we are seeing markets indicate a little bit higher after yesterday's sell-off. This is Bloomberg Surveillance.
There is this whole concept that we are way too restrictive. But that is only if you have our star or where the Fed is going at a much lower level, mainly I say 2.5 or 2.8 as the long run dot says. Then it's true that we are restrictive. Then you need to see the Fed cutting rates quickly. What is the incoming data telling us? The Fed last hiked rates in July of 2023 and still now 12, 13 months later, we're still waiting for the data to slow down. Godot didn't arrive here over the last really 18, 24 months. Why should Godot arrive in August of 2024?
Waiting for Godot here in Jackson Hole. That was Torsten Slok, Apollo chief economist, talking to us about the Godot of a slowdown that never came, or at least not yet. No one's really talking about mission accomplished here. There is a shifting focus, though, to the employment side of the mandate. Tom Keene here, and honestly, to me, I think that's the most interesting thing. People are very much looking at weakness rather than really talking about inflation and the difficulty of getting it to 2%.
We're going to advance this in a moment with the view from across the Atlantic, but you had it dead on earlier, Lisa, this nuance of gradual and measured or sudden glide paths of how we come out of crisis, or as Adam Posen said, at a choice point like we're at right now. What are those decisions, and do you stay gradual or do you stay measured? That's unspoken in America, where in Europe it's much more overt.
Yeah, it's much more overt at a time where maybe the mandate is a little bit more challenging in terms of both the weakness and the inflation. Joining us now to talk about it is Bank of Portugal Governor and ECB Governing Council member Mario Centino, who can tell us all about all of the beautiful places in Portugal that we all want to go. Thank you so much for being with us here today. Let's go there. How different is the picture in the U.S. versus Europe when it comes to the dual mandates of inflation and employment?
Good morning, and thank you for having me. It's not as much of the mandate. We always have to look at the data as a whole. We know that prices are the result of what the economy is doing at any moment in time. We have an economy that doesn't grow in Europe, contrary to the US. In the last 2 years, the European economy grew by less than 1%, while the US economy expanded close to 5%. This is a completely different picture. And inflation in Europe came down very fast, actually faster than it went up. We are approaching 2% in our forecast. Since we first forecasted 2025, the forecast for inflation was at 2%. Anchoring expectations in Europe has been part of what we see in the data since the beginning of this inflationary period. Today, we look at the five-year inflation, and it's 2.1%. That includes a risk premium, so that means that inflation expectations are actually below 2%, most likely. So this is the differences. These are most of the differences that we'll see in a nutshell between the U.S.
You were weaned at Harvard with Lawrence Katz, so you've got a real understanding of American central bank history. And of course, so much of that is Greenspan and measured. There's a raging debate in Europe right now about the path you're going to take, looking at real rates, looking at the nominal rate, and how to be gradual, how to be measured in a newer bank, the ECB. How do you perceive the rate trajectory being given disinflation as you try to move to a European soft landing?
Well, the case is that Europe landing was to a plateau. We are not growing, so the economy is not growing. Let me take that again. We need to continue in Europe working towards better policy coordination, fiscal and monetary. That has been a huge problem in Europe in the last 2 decades. 2020 was a great example of both policies moving together. We need to continue in that vein. And that actually tells a little bit the difference between the US and Europe as well. Mm-hmm. I am very happy that fiscal policy in Europe in the last couple of years helped in the disinflationary process, because it was much more contained than the one in the US. And we have to continue working together so that this coordination makes everyone's work easier.
I interviewed Christine Lagarde here exactly 12 months ago, right on this spot, and she wanted a new ECB monetary policy and process of monetary policy. What do you see as the ECB policy forward after the Olympics, after the huge 24-month success? What's the policy forward given a slowing European economy?
Of course, the most likely move in terms of monetary policy is to continue cutting rates, so the easing process.
Would you like to give us a date on that so we can make some news today? Our colleagues at the ECB are like...
September, it's easy. Okay. October is going to be a funny meeting. Okay. It all depends on the new data. It's always dependent on data, but it's not on data points. It's on data trajectories. We don't look at data points. We look at data trends. So that's the important thing also to mention here.
You were talking about the difference between Europe and the U.S. and saying essentially the trend in inflation is actually lower in Europe than the U.S. So why does it make sense for the U.S. to be forecast to cut more aggressively than Europe?
Well, let's see what happens. We still don't know what will be the trajectory for the U.S. I think the decoupling story is not an important one. We have to look to the numbers in our economy. We are a 350 million citizens area. We need to bring inflation down with the lowest possible sacrifice. And there has been quite a bit of a sacrifice in Europe to bring inflation down. It's even in this soft landing story, we don't grow. Investment is very low in Europe, even in a situation in which we have next generation EU investments popping up new investments in Europe. So we really need to take this seriously. The gamble for me right now is whether or not the labor market tensions will come up, because this will be the main risk that can turn the game a bit.
Will the ECB ever go back to negative rate policies?
Well, we don't want to. We are working very, very hard to avoid that. But we must remember ourselves that before this inflationary period, for close to 1 decade, average inflation in Europe was 0.9. So the fundamentals of the European economy are not compatible with inflation above 2%. We need to be very careful about it. And again, the gamble is, will employment hold in the context of a stagnant economy or not? Because if it doesn't, then everything will speed up.
I have 30 seconds. The American economist Madonna said a couple years ago, Lisbon is the place to be. What is the magic about a Lisbon where Madonna says everybody in America has to move there?
You know,
what's a pixie dust?
It's the people, the light, and the food.
Okay, can I just say, he's trying to basically see if he can get property there, and he knows that Americans are banned, so he's trying to lobby it.
We're lobbying here.
Yeah,
Make a
you'll be
governor.
welcome.
Okay, thank you. There, just
really?
get that on tape.
Oh,
thank
boy.
you.
Thank you, Portugal Governor and ECB Governing Council member Mario Centeno. Thank you so much for being with us. We are just about less than 5 minutes away from Jerome Powell. We are going to bring that to you live when he does come out and give a speech. Really curious to see, Tom, how much he gives the market what it's looking for in terms of rate cutting path versus doesn't try to rock the boat, because why?
Yeah, we'll have to see. I think Mike McKee's on top of it, and he'll have a lot of in-depth coverage of that right at that moment.
We'll be talking to former St. Louis Fed President Jim Bullard, Tracy Alloway, and Joe Weisenthal of Odd Lots. Also, don't miss this, former Kansas City Fed President Thomas Honig. From a beautiful Jackson Hole, just moments until we hear from Jerome Powell. This is Bloomberg Surveillance.
jobs day like Bloomberg. This is Bloomberg Surveillance, live from Jackson Hole, with Tom Keene and Lisa Abramowitz.
Good morning from Jackson Hole, where all of economics, finance, and investment await the Powell speech. Lisa, this is the moment hugely anticipated, particularly in the last 2 weeks.
Yeah, we are waiting for his speech. Last year, he used the word labor market 13 times, used the word inflation more than 40 times, I should say, giving you a sense of where the focus was last year. This year, expected to be reversed.
And very quickly here, I would look for a longer, more developed speech than what we saw 2 years ago, I believe it was, the 9-minute wonder. We're not going to see that today.
Yeah, that was record-breaking in a lot of ways. Joining us right now, Bloomberg's Michael McKee ahead of this speech. We are seeing an introduction to Jerome Powell, who is in that room right ahead of us. What are we expecting? What are we hearing right now?
Well, we are waiting for him to come up, and in about 2 seconds, we can tell you that there is going to be market-moving news. Jay Powell is going to announce that the Fed is going to be cutting interest rates. The takeaway today, the balance of risks has changed, and it has become more important for inflation.
Yeah, Mike, let's head over right now. Jerome Powell, the head of the Federal Reserve. Let's take a listen.
4.5 years after COVID-19's arrival, the worst of the pandemic-related economic distortions are fading. Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our two mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials, like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment, in the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss, and this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession, in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that, as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6% and core was above 5%. New supply shocks appeared. Russia's invasion of Ukraine led to a sharp increase in energy and commodity prices. The improvements in supply conditions and the rotation in demand from goods to services were taking much longer than expected, in part due to further COVID waves in the United States. And COVID continued to disrupt production globally, including through new and extended lockdowns in China. Higher rates of inflation were a global phenomenon reflecting common experiences: rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s. Back then, high inflation became entrenched, an outcome we were utterly committed to avoiding. By mid-2022, the labor market was extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade. But labor supply remained constrained, and in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage. And inflation peaked at 7.1% in June 2022. At this podium 2 years ago, I discussed the possibility that addressing inflation could bring some pain in the form of higher unemployment and slower growth. Some argued that getting inflation under control would require a recession and a lengthy period of high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points in 2022 and another 100 basis points in 2023, and we've held our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer-run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. This narrative attributes much of the increase in inflation to an extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time. That confidence has been built over decades and reinforced by our actions. That is my assessment of events. Your mileage may differ. So let me wrap up by emphasizing that the pandemic economy has proved to be unlike any other, and that there remains much to be learned from this extraordinary period. Our statement on longer-run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. As we begin this process later this year, we will be open to criticism and new ideas while preserving the strengths of our framework. The limits of our knowledge, so clearly evident during the pandemic, demand humility and a questioning spirit focused on learning lessons from the past and applying them flexibly to our current challenges. Thank you.
That was Fed Chair Jay Powell wrapping up his annual remarks in Jackson Hole. We just heard a couple of really key metrics, and I want to go through them. That the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data. We do not seek or welcome further cooling in labor market conditions. Tom Keene, to me, this was very much heralding the beginning of a real rate-cutting cycle, and not declaring victory, but seeing the emphasis very much squarely on the labor market.
Yeah, what I got right was that I thought every sentence would be crafted, and that's what I heard. I loved the last paragraph of the speech where he talked about the humility required forward and the limits of our knowledge. And a lot of what we're talking about here at Jackson Hole, and what they're talking about just over the behind the cameras, folks, is the limits of our knowledge, the humility of, okay, we got through a pandemic, now what?
Well, right now, what in markets is this is a Federal Reserve that is embracing market pricing, and markets are rejoicing. You could see stocks surging. You could see yields lower across the board,
and
down about 7 basis points.
And kept driving lower,
yeah. Which is actually a bigger than average move following a Jackson Hole speech. You see a lot of dollar weakness out there. You see the euro touching up on its strongest point, going back more than a year to July 2023. So you see this really sort of confirming the bias that we already saw in markets.
It was great. McKee came out of the embargo. We were talking halfway through the speech. He's day trading with Robinhood, trying to get out in front, of the move. Is this a seismic change? Is there more going on here than I perceive?
First of all, let me say I did not trade with Robinhood, if anybody is listening. This is not a seismic change. This is just confirmation that the change is finally here. The Fed has been teasing it for quite some time. They've been looking at the data, waiting. Inflation's come down. They keep saying we just need a little more effort, a little more proof. And now Powell is saying we've got that. His confidence is high. And the takeaway is that the balance of risks for the Fed has changed. They have now gone from worrying about inflation to balance between inflation and the labor market. And now it's tipped a little bit into the labor market worries. As you pointed out, Lisa, he said that we do not welcome any further deterioration in the labor market. So they're ready to cut rates, did not go in the direction of by how much, but didn't suggest there would be a big cut, but confirming what the markets were believing, that in September we're going to get a rate cut.
And if you end up looking at what the Fed funds futures are saying, it's basically where they were before, between 25 and 50 basis points of a rate cut in September. I know, Tom, you're saying, what does it matter? But at a certain point, what this does mean is this is a Jay Powell that is very much on the same page with markets. Key to me was also this discussion around how much was due to Fed policy. Is there a sense that this is something that needs to be adjusted in a real way in terms of dropping rates with some acceleration through the end of the year?
Well, I think basically he's defending the Fed because there's been a lot of criticism, and they're going to go into this review. And people are going to be saying that the Fed should change the way it does things. And I think he's trying to stake out the position that, well, we were wrong, but so was everybody else, because this was a highly unusual situation. And that's why we got it wrong. And so it's a little bit interesting historical, I don't know if you would call it revisionism or just laying down a marker for the future historians of the Fed.
Well, Neil Dutta of Renaissance Macro, who has been a critic of the Fed, saying, please, just let's go already, says this was a good speech. So confirming what he was hoping from the Federal Reserve. Joining us now is someone who has been in that room, who has seen the decision-making and the speech crafting, former St. Louis Fed President Jim Bullard, joining us now. Jim, I would love your take on this speech. What did you think of it?
I thought this was a good speech. I thought it was not quite a victory lap, but certainly emphasizing that this policy since 2022 has been extremely effective in bringing inflation down substantially, putting us on a path to 2% inflation without substantial weakening in the labor market. The labor market was super hot. It has cooled, but it's only cooled to a sort of normal labor market. And so that's why everyone's talking about the soft landing. So I think to the extent there are critics out there, which is great, they have to contend with the fact that this policy worked very, very well over the last 2 years.
Jim Bullard, to your acclaimed speech years ago on regimes, of a Fed staggering from regime to regime or planning from regime to regime, does this speech signal a new post-pandemic regime?
You know, this is going to be studied for years. This episode about disinflation without recession will be studied for many years, and exactly how it works is a good question. But Chair Powell said in the speech, I think, basically lined out the argument: if you can keep inflation expectations on target, and even when the world seems to be exploding with inflation, then you can get the disinflation to occur relatively rapidly and relatively painlessly. So I think that's a new mode for many people in thinking about how monetary policy works.
I've been asking this question, Jim Bullard, of many, and with great respect to your public service out of St. Louis, where is the unemployment rate that begins to hurt? For Jim Bullard, I think a lot of America wants to know, what's the statistic in unemployment rate where it says some pain? Is it 5%? Is it 4.x%? Where's that number for Jim Bullard?
You know, estimates of the natural rate for most people are in the mid 4% range somewhere. And so I think it's true that unemployment has come up, but it's come up from this, you know, a 3 handle that it was at for several years. I think what you should think about is that the 3 handle is the thing that's unusual for the U.S. economy. 4 handle would be a very normal market turn. And now we're at that level. Now, if it goes up from here, if it goes up substantially from here, you know, that's going to be a substantial weakening. And that's why I think Chair Powell didn't want to get anything further to happen in the labor market. I think he said further cooling is unwelcome. Yeah.
Jim, I sat Jim Bullard here easily a decade ago with Alan Meltzer of Carnegie Mellon, and he lectured me on the silliness of a 50 basis point move. If we discuss a 50 basis point move, are we defeating all the history of measured and all the value of a gradual approach?
Yeah, I just think right now they just probably don't need to go 50 basis points. I think that would, trigger expectations about a really rapid pace of rate decline. They probably don't need to do that. They would like to asymptote, have the inflation come asymptote down to 2%. Also, basically with this speech and certainly with the July meeting as well, they've been heavily signaling that they're going to make this move in September and subsequent moves. So that's already been priced in the markets. So they'll just be confirming at the September meeting what's pretty much already happened as far as market pricing.
Jim Bullard, the former St. Louis Fed president, thank you so much for being with us following that speech from Fed Chair Jay Powell at a time where markets are screaming higher. You could see that really advancing, in particular with the Russell 2000 up more than 2% on the heels of confirmation of the rate cutting cycle.
Crisis over.
Well, is it crisis over, or is this a new emphasis? How far will they go? A lot of questions around that, and we will continue to, of course, play that parlor game simply because the data dependency lives on, and that's what will determine the pace of the cuts.
Here we are with an event, and then the next event, I believe, is September 6th, which is not back to school. It's a jobs report. And, after the shock of 114, and, of course, the revisions off that, the revision here, I guess we knew it would be important, but maybe off the speech and the market move, it's ever more important.
Yeah, you're seeing the market move across the board through bonds. You see yields lower across the curve. Two-year yields down some 7 basis points, which is more than the average of 5 basis points on Jackson Hole Fed speech day. Coming up, we do have the hosts of Bloomberg's Odd Lots podcast. We have Tracy Alloway and Joe Weisenthal, plus Dana Peterson of the conference board. We're going to be dissecting the speech and what that means for the path ahead. This is Bloomberg Surveillance. time has come to adjust policy. The clarion call from Jay Powell, the start of the rate-cutting cycle is to begin. The focus on the mandate has shifted. Tom Keene, Lisa Abramowitz here in Jackson Hole as we see markets surge higher on the heels of a speech quite a bit longer than the 8-minute pain speech that we heard 2 years ago, heralding the beginning of that rate-cutting exercise.
It's a substantial move here. What's important, I think of Ian Lingen at BMO Capital Markets saying that we've set a new regime of a lower set of higher yields, if that makes sense at this time of day. But the bottom line is, Lisa, is we come in with lower yields, bonds up, and equities lift up as well. Dollar weaker.
What we can see is the Russell 2000 leading the way up 2.5%. Yields lower across the curve, although backing away from some of the initial moves, down just about 5 basis points on that 2-year yield, 3.96%, confirming market expectations for a rate-cutting cycle.
You look at the 30-year mortgage, how it's coming in, Lisa. I know you want to continue the rate check. You're looking at 3 bedrooms in Jackson. Think what the mortgage rate's going to be.
Why is it always about where people are going to buy property, Tom?
Because that's what's going to happen here, and this is when this is important. I asked this to Loretta Mester, and I said, is this just an economy policy for the haves? And that if you get a rate regime down, real estate explodes up once again.
And you also asked to buy some Portuguese real estate from the Portuguese head of the central bank.
We're trying to
move on a little bit. Joining us now to save us are the hosts of Bloomberg's On Laws podcast, Tracy Alloway, as well as Joe Weisenthal. Tracy, what was your takeaway from the speech?
I think it's clearly a shift from the emphasis on inflation to labor markets. I think what's a little bit interesting now is the Fed has emphasized so much that they are data dependent. I know they say they're not data point dependent, but data dependent overall. But with everyone now very focused on the labor market, I guess my question is, if we get an interesting jobs number, right? Like, what happens then? What if the jobs report comes in slightly better than expected? Does that put the entire path of the easing cycle in doubt?
Adam Posen alluded to this in his call, in his FT article 2 days ago. Dr. Posen made real clear everybody's setting up for complete disinflation, and he's saying, wait a minute, out in 2025, you could go the other way, as maybe they're worried about in Europe as well.
Yeah, I mean, I think there's still a lot of ambiguity, especially like right here in now, August 2024. I think that, it makes sense to say, look, the focus has shifted, and Powell is very clear. It's like, we do not want to see any more labor market weakness. We are done with that, and we feel confident on inflation. But the slightly longer-term outlook, because, we just went for years and years and years with almost no inflation, and the memory of 2022, 2023 is not just going to go away. So I do think one of the sort of maybe interesting medium-term questions is whether that's sort of like, still the surprises are more on the upside, and whether there is sort of a lingering sense that businesses have pricing power and can sometimes raise prices when the economy is good, will be a challenge for a while.
Tracy, what I noticed, and to me one of the most important statements here was Susan Collins of the Federal Reserve Bank of Boston, saying that pessimism or entrenched pessimism or worry or angst, it's not the American way, and that we need to be more optimistic. And I heard that in the Powell speech, and particularly the final paragraph I thought was critical, really almost talking to the politics, but saying, look, we need to be humble. The humility of the moment is key.
Yeah, I think it's kind of funny that in some respects this is a little bit of a victory lap for the Fed, right?
Yes, exactly.
That's absolutely fine. But the irony is that the models weren't working for the past couple of years. The business cycle was so weird that no one could explain it using things like the traditional Beveridge curve or the Phillips curve. And so they started talking about the data. But now that the data is also kind of squirrely, and we saw that with the BLS revisions recently, people are starting to talk about the neutral rate of interest again. And so I wonder if we're sort of going to get another shift going back into the models, and whether we're sort of on a pendulum here.
My favorite thing is when we ask people what the neutral rate is, no one gives us an answer at this point. I think you probably have seen the same thing. So you guys are here in Jackson Hole.
Yeah.
Who do you have on Odd Lots? What's coming up?
We have some great guests. I don't know. Can we say we have the luminaries? We're going to do speaking, we have an interview later today with one of our faves, Hyun Sung Shin. We're going to be talking about the yen carry trade, things like that. We may be speaking to a certain Fed governor that'll be out later.
Talking about what it's actually like to be a Fed governor at Jackson Hole. And that'll be interesting. And Tom.
And Tom is going to come on.
Make an appearance. My people just told me.
Yeah, sorry, Tom. We're making you do that.
I got to take a later flight. Do you know what a Gulfstream costs?
Maybe you could just save some of that to buy a property in Portugal.
Yeah, we'll see.
Tracy Alloway and Joe Weisenthal of Bloomberg's Odd Lots podcast. I'm looking forward to all of those interviews. Thank you so much for being with us, as well as pictures of you both fly fishing, which I believe has been
Did you see the
activity.
sturgeon she caught?
Yeah.
My word.
I have to say it's a white fish, but thank you for making it sound more impressive than it was.
It's great, and she's naming it, and she's going to reveal the name on an Odd Lots podcast coming to a home near you. Right now, we're looking at markets that really are celebrating the confirmation that we got from Fed Chair Jay Powell that the beginning of a rate-cutting cycle is to begin. Let's just sit on the Russell 2000, continuing to climb as time goes on. This rotation into small caps, some of the more leveraged companies very much getting the biggest benefit from the beginning, the onset of this rate-cutting cycle.
Absolutely perfect, and it totally cuts into what Susan Collins said, in that part of that is a massive shortcut, a short squeeze, I should say, of that leveraged small cap, more supple trade, and it's coming back with a vengeance.
What's interesting to me is that there isn't the same kind of move in the 2-year, in the 10-year, and the 30-year. When you look at the rate space, that's moderated. It's not the same kind of celebration, which is sort of typical. If you look historically, typically equities have a bigger move, an average of 1.3% move one way or the other, versus the 4 or 5 basis point move in the rate space, and that's basically what you're seeing today as well. Down about 5 basis points for the 2-year yield, 3.95%, as we end up with this feeling that rates are going to go lower. Still a big question of where they end up, given the fact that ultimately we don't have a sense of neutral.
Jackson Hole Audible, we're going to do it right now with Lisa Abramowitz off of the August collapse of 10 days ago. It seems like it was 3 weeks ago, but it wasn't. What has the spread market done? What does the spread market, high yield credit, what does it signal right now, Lisa?
It signals calm. It signals faith in this sort of soft landing. You saw, a brief hiccup, but nothing that really screamed recession, which is the reason why people are saying ultimately maybe this is a Fed that can land the elusive soft landing.
And so it's a question of corporation confidence, which means you go to the conference board because they're in charge of that.
We will. Yeah. With a dollar that is weakening, the weakest versus the euro going back almost a year, more than a year actually. Joining us now is someone who can talk about confidence. Dana Peterson, chief economist at the conference board. Dana, wonderful to see you. Thank you for being here.
Great being here.
I'm wondering what you make of what Jerome Powell had to say about how in the past 6 months there has been a market deterioration in the labor market and that they would not welcome any additional cooling.
Well, I think they don't welcome additional cooling because we're probably right where we should be. This is kind of the Goldilocks labor market. It's normalized after a steep decline during the pandemic and then a rush to fill jobs where we had outsized job gains. Now we're probably right where we should be. The unemployment rate has risen a little bit, but it's still relatively low.
I look at the Fed speech. I'm going to have to actually go back and read it. I think it was carefully written. The last paragraph, as I've said 3 times now, to me was just critical about a new humility. Their humility is going to be research, which goes to the conference board's core ability, which is what business is thinking. Do you look for a lessening of investment in Q4 and into next year by business?
Well, they're not really saying that. It really depends on what industry. So industries that have benefited from reshoring and infrastructure building, those companies of ours are doing very well. But it's the companies that are tied to the consumer. They are concerned and they are looking at maybe pulling back.
Are they supple? The big theme for this year is corporations adjust. How does big box retail adjust? How do the department stores adjust, which is a real risk to their future? How does small business adjust in consumer?
Absolutely. Well, we've seen kind of mixed news from the consumer. We thought that spending on goods slowed and certainly was negative in the first quarter. Then it came back. And I think that's because prices start falling for those big ticket items. But I think the future is slower growth in goods spending, and that's going to impact those companies that are B2C.
One thing that I am really struck by is people keep saying that Fed Chair Powell is going to be talking about the path of rate cuts, the path of where we're, the destination, right? We don't know what the destination is. Have you heard anyone in those meetings talking about a neutral rate of any specificity, or is it still a big question mark just sitting out there on that board?
I think it's a big question mark, as Chair Powell said and has said often. It's really going to be about the data, and the data is going to drive how much and how quickly they're going to dial down interest rates to reduce that level of restrictiveness. Our own view is that probably rates are not going to go back to where we saw pre-pandemic because we have a number of factors now that are more inflationary.
So this is the problem that a lot of people are having with data dependency. We've seen a lot of contradictory data. You could tell a different story depending on what market you look at. You can look at the housing market and say something is broken because things aren't getting done. You could take a look at the labor market and question how accurate and who exactly is getting employed. How do you understand what data dependency means at a time where it's getting harder and messier to really look at that data?
I think that's a huge question. Certainly post-pandemic, many of the models have broken. And so just depending upon your forecast is not enough. You really have to look at what's coming in and really make tough decisions about where you think the economy is. And I think that's where the Fed is.
The final paragraph, he talks about the limits of our knowledge. As you grind it out every day at the conference board, what's the limits of your knowledge in studying the American economy? What's the biggest mystery or opaque issue out there right now?
I think the big word is uncertainty, right? Uncertainty doesn't fit easily in models, and that's what we've had. We'd have a number of shocks, repeated shocks, that really just upend things. And so certainly for businesses, uncertainty is holding them back from making really big investments unless they see a big return. So I think that's the challenge we're facing.
I need a single point estimate here. What's your nominal GDP call for 12 months forward?
I think it's 2.3%.
Real GDP. What's
GDP.
Nominal GDP going to be?
Oh, nominal?
Sub 5? Sub 5%?
If you add around 3% inflation, it's just a little bit over 5.
That's not bad. That's solid.
Yeah, well,
that's solid.
That's seriously what a lot of people are saying. What is your number one question after hearing that speech, Dana, before we let you go get geared up for the Western-themed dinner tonight?
Well, my number one question is, well, what happens on September and then thereafter? Our view is that the Fed can move slowly as long as we don't have big downside shocks to the labor market. Chair Powell said they're mostly focused on those downside risks to the labor market, whereas they feel like they've more or less eradicated the risks associated with inflation.
Is there a difference to you if they go by 25 basis points or 50 basis points in September?
I think in the grand scheme of things, it's not really that important because you're still going to have a very restrictive policy rate. But it does send a message. If the Fed goes 50 basis points, it suggests that the economy is in trouble. They see really dark clouds coming and they need to get out ahead of it.
Dana Peterson, always wonderful to see you. Thank you so much for being with us. Dana Peterson there, chief economist at the conference board. And that to me is really one of the questions. You know, what are they signaling to markets if they cut by 50 basis points, Tom? I think that Loretta Mester actually put it very well, that if they go by 50 basis points, the market will go even further. And if they go 25 basis points, that doesn't negate the idea of going further later on.
You're getting me in trouble here. I'm not supposed to give my opinion on this. I'm not going to do it now. I think it's just a strained discussion. I think we've heard that today from a number of voices of getting to the drama of 50 basis points set. Dana Peterson just told us we've got a 5-ish nominal GDP. That's not a recession. And the critical question unspoken here in Fedland is what are earnings going to be? And as we get through September, modeling out Q4 earnings, beginning the complete mystery of 2025 earnings is just as important.
Will companies adapt and adjust?
Yeah, I don't,
I'm just
they're
kidding.
going to adapt and adjust, and we're seeing that in a lot of micro things. To Dana's point, we may really adapt and adjust in consumer areas like retail. That may be the key focus.
Well, coming up next, adapting and adjusting to the speech, former Kansas City Fed President Thomas Hoenig, as they parse through all of the different Fed officials, parse through Federal Reserve Chair Jay Powell's speech, which lasted longer than 8 minutes and sent a clear rate-cutting signal. From a beautiful Jackson Hole,
It's gorgeous.
This is Bloomberg Surveillance.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. While the task is not complete, we have made a good deal of progress toward that outcome. My confidence has grown that inflation is on a sustainable path back to 2%. Today, the labor market has cooled considerably from its formerly overheated state. The cooling in labor market conditions is unmistakable. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market.
Not exactly a call of victory, and yet talking about maybe this is what it looks like to stick a soft landing. That was Fed Chair Jay Powell speaking earlier from where we are today, Jackson Hole, Wyoming, where they do seem to be kicking off the beginning of a rate-cutting cycle. Tom Keene, to me, that really was the big takeaway. It is beginning, and it is beginning soon.
That was a single sentence, but throughout it all, and I think it was an incredibly well-crafted speech, clearly important, clearly a post-pandemic sea change. But the real issue is this is a Chairman Powell who at the back end of the speech said now is a time for humility.
Yeah, well,
there's a lot of that. I think that's an allusion to the election and the incredibly intense economic policies we're getting both from Trump and Harris. I'm just trying to rile up Tom Hoenig.
Well,
I'm just trying to get him going.
Thomas Hoenig is here. He is. So let's go to him right now. Former Kansas City Fed Thomas Hoenig. I'm very curious to see why you actually think maybe it is too soon to sort of sound the all clear and the victory signal that we seem to hear from Federal Reserve Chair Jerome Powell.
Well, I understand where he's coming from, first of all. And, first of all, we have an economy that is strong but slowing, which is what you want. You have a labor market that has been strong but slowing, as you would expect and want. And thirdly, you've had a relatively tight interest rate environment. If you think about it, real interest rates are between 2.25% and 2.75%. If the equilibrium rate is around 2, you're modestly tight, so you would expect a continuation. And that's what he said. We expect to see a continuation in the decline of inflation. So with that in mind, we are getting close to where we can make a cut. So that's the statement. But the fact of the matter is, and here's the catch, inflation is between 2.5% and 3%. I know they like to use the PCE, but there is a CPI too, and the CPI is 3%. And that's what people index to, and that's what people look at. So inflation is still, if you say 3%, it's 50% above target. So why are you in such a rush? So that's the counter argument to that. But I think based on what he said was, we're very close. The next move is down, and that's what they've been saying for 9 months, and that gives the markets kind of if we're going to speculate, let's speculate long, because rates are going to go down.
The heritage of this discussion out of your Iowa State economics and all you did in building Kansas City is a distrust of those people over on the East Coast and maybe the left coast about the debt and the deficit. Yeah. Tom Honig right now, you got every Trump supporter, every Harris supporter is looking at the debt and the deficit and saying, you've got to be kidding me. How afraid of you are the fiscal realities of America folded into our monetary policy?
Oh, it's very much folded in. For example, regardless of what they do, the deficit is only going to grow. We know the interest on the debt is exploding. We have a huge deficit of $2 trillion. It's going to continue to be well above $1 trillion for some time. So here's the question: who's going to loan them the money? Is it going to be the foreign interest? They're pulling away from the dollar somewhat. Is it going to be domestic? Well, how much do you want to take away from the private sector to fund the debt?
Right.
And then maybe redo it in some kind of fiscal stimulus, which is less efficient. Or are you going to turn to the Federal Reserve? And I call it knocking on the central bank's door, because when you're the only source, if you're going to keep interest rates from exploding, the Fed's going to have to print money. It's well reported you've got Krugerrands in your dresser in your bedroom. Gold at 2,500. I mean, we go back to Wayne Angel. We can go back further than that. The primal Midwest economics has got to be screaming about the combination of the debt and the deficit and gold at 2,500. Well, I hope it's more than the Midwest, because it affects the whole nation, and it is a very significant problem. The dollar used to be a stable coin, right? Tied to the gold. This is the first. Somebody take a note. Tom Honig quoting Bitcoin. Stable coin. Really? Well, look at it. It was backed by the gold, and therefore you had discipline around it. Now it's all fiat, right? Which is fine if your policy is... Can we extend an hour? He's just getting fired up. Look. Well, think about it. That's all I'm asking you to do. Think about it. What is the discipline to the value of our currency? It's the FOMC. With more and more pressure coming from the size of the debt that we have to fund, someone has to fund that.
Not to go too far afield when we're talking about the gold standard, this goes back to the question of inflation and just how pegged inflation is in this economy that does look different than it did pre-pandemic. Do you have any concerns about the fact that we don't understand neutral, and we talk about normalizing policy without a sense of where we're going?
Well, I think people know where we're going, and the estimates on neutral are like every other estimate. It's not certain, but many researchers now are saying neutral is around 2%. So if neutral is 2% and the rate, the Fed funds rate real rate is 2.25%, 2.75%, you have a tight policy. And the other part of it is, and I will say Chairman Powell emphasizes, is inflationary expectations. So if they can stay firm in terms of we're not going to ease so much that we reignite inflation. We don't know what that is, but we know we are somewhere around real rate of 2%. We'll get our rate down to 2% as inflation comes down. And if they move in September, the main thing will be how they message it. Because if they don't message it right, the markets will immediately start saying, well, when's the next quarter or 0.5 percentage point? And then you will lose that anchor.
I like what you said because it hints to where I was going to go next. Is this a Federal Reserve that wants to see a market rally? Because ultimately that's more supportive of no further deterioration in the labor market?
I think this is a Fed that doesn't necessarily want to see a market rally, but it does not want to see inflation reignite, nor does it want to see unemployment start to rise. So they're in that tight spot, and that's why they're being very careful as they go forward from here. But they have a lot on their shoulders.
There's a state in the vicinity of Tom Honig. It's called Missouri.
Yes.
McChesney Martin came out of Missouri, and he and Truman of Missouri had a pitched battle in the early 1950s. Are we going to redux Fed independence battle into 2025?
Well, yes, it's possible because of the pressure to print money to buy the debt of the U.S. government. And that's when the Fed, I think it's hard decisions are ahead of them, because I think the Fed's going to have to say, behind the doors, I don't care how they do it, Congress, get your house in order. We cannot carry these kinds of debt forward and retain ourselves as the strongest, most reliable currency in the world.
We're out of time. Can you get chip beef on toast back on the menu at the Pioneer Grill? With all your power, can you get the menu back to what it was?
I'm not hosting this anymore, so my power is kind of limited, so I can't promise.
Honig sits and they put avocado toast on the menu. Avocado toast at Jackson Hole?
I'm a fan. Former Kansas City Fed President Thomas Honig joining us here in Jackson Hole. Thank you so much for being with us. It was a seminal speech, maybe not the 8-minute Spain speech that goes down in history, but this really was historic. This is a Fed chair declaring not victory, but the end of a tight cycle that led to what a lot of people think is potentially a soft landing. Now, the question is, how much, to Thomas Honig's point, how much are the hard decisions ahead of them as they try to navigate the fiscal with the monetary policy?
I'm going to be talking to Paul Sweeney Monday about what Powell said about a need for humility and the lessons learned coming out of a health disaster. Let's remind ourselves the pandemic is only equivalent to post-World War I. And this new humility that he mentioned to me was a key paragraph, without question.
Let's take a look at what humility looks like in markets. Humility looks like a rip-roaring rally as people welcome what we heard from Federal Reserve Chair Jay Powell. We do see the Russell 2000 outperforming up more than 2%.
Look at the euro edging 112.
But yes, that to me is interesting. The fact that the euro is the strongest going back July of last year. Dollar weakness across the board, 111, almost 112 for that euro. 10-year yields lower by about 5 basis points. 2-year yields lower by a bit more as people bake out how much they could potentially cut rates, not 25 or 50 basis points next month, but also beyond that. Coming up next from Jackson Hole, don't miss this, Philadelphia Fed President Patrick Harker and his take. Later today, Chicago Fed President Os Goolsbee and former Kansas City Fed President Esther George. This is Bloomberg Surveillance.
is Bloomberg.
From Jackson Hole for our radio and television audiences worldwide, this is a Bloomberg special interview following up on Jay Powell, Fed Chairman's speech here in Jackson Hole. We have Philadelphia Fed President Patrick Harker joining me, Lisa Abramowitz, and Tom Keene. And we'd like to thank you very much, Pat, for coming out, interrupting your seminar. Rumor has it you're going to cut rates.
Yeah, that's what I hear.
Was it you've been somewhat reluctant? Are you on board?
No, I said the last couple of days that it's time to start a process. And I think it's a process. It's not about a particular number. The process needs to be dictated by the data we see, but we need to start moving rates down. No question about it.
Well, if you start moving rates down, the one thing that didn't come through in the speech is by how much?
Yeah, and again, I think we need to let the data dictate this. I think what matters more than a particular number. Now, I've been out and about my district all summer talking to contacts. And one thing I heard is 25, 50, that doesn't matter so much as commit to a process. Be methodical about the process. In particular because what I've heard, particularly from the bankers, is they need time to absorb the changes. So don't just stop and start. Don't just do a large decrease and then stop and then starting it. Just start a process and keep it moving.
This, to me, really underscores what Loretta Mester was saying, formerly of the Cleveland Federal Reserve, where it makes sense for the Federal Reserve to go by 25 basis points to begin with and then potentially cut more significantly later on, because then you're not signaling to markets that you're going to go much further. Is that what you agree with?
Yeah, and we'll see how things, there are a lot of risks still out there in the economy, in the global economy. So we start with 25 and we just let it run and keep moving. And we're already seeing it, right? We're seeing the long end of the curve start to come down. That's been good. The mortgage business is back. You talk to bankers, they're starting to write mortgages again. That's all good news for the economy.
I've got to ask the engineer the question. Susan Collins was channeling Patrick Harker here the other day. She says, we need to lose the pessimism. We need to be more optimistic about where we are right now. What do you more than anyone I know, listens to business. Yeah. What are you hearing from business about investment next year, about their confidence forward?
Yeah, they're cautiously optimistic, I would say, right now. I think they are optimistic, but depends on the industry and depends on where they are in their own business cycle, right? But yeah, generally we're seeing, take housing, for example. Housing is a good example. We know that a lot of developers are sitting on their hands waiting for rates to come down, for this process to start. I think that's a good thing because we need them to build affordable houses, low, moderate income houses. And I think they will do that as we start this process.
When the chairman spoke today, he suggested that the balance of risks has changed. Inflation is coming down, and it's probably not going to shoot up again because of the rising unemployment rate. But the rising unemployment rate, in turn, is a bigger risk at this point. How much of a risk do you see of downturn from unemployment?
So I don't see a large outside risk. The unemployment can go up some, right? And it probably will go up a little bit. It will definitely, in our view, not peak above, say, 5%. I mean, it will be below that for sure. No, not for sure. Nothing's for sure. But you got to look at the totality of the data, too. It's not just about that number, right? It's about what we're hearing from our contacts, the claims data, the job-to-job transition data. There's a host of data you have to look at.
Well, this is a confidence question. Recessions are always a confidence question. You're talking about confident CEOs that the business is going to be okay. But what do you hear from the average person who could pull back if they see the unemployment rate going up?
It really is a tale of two consumers, to simplify things. Those who have the money are spending the money. They're not that concerned. Low, moderate income households are really still feeling the pain. They're feeling the pain of housing prices, food prices, you name it. So they are very concerned. So it really depends. It's not one size fits all. There's not the average consumer. That person doesn't exist in our economy.
So everyone's talking about this process, right? You talked about that too. This is the beginning of a process. One thing that Neil Dunn noticed was missing was the word gradual from Jay Powell's speech. We can get to that in a second. Do you have a sense of where we're heading?
Yeah, so I like the word methodical. That's what I'm hearing from my contacts. Please just make it so that we know where you're going in a very clear way, and then you start that process and don't just stop and start, as I said earlier.
So where are you going?
Well, we're going to go back to whatever that new neutral rate is.
Well, do we have an idea of what that could be?
Yeah, I mean, we don't know exactly what it is. We'll know it when we get there. Let's be honest. You can't know it a priori. But, it's probably something around 3%-ish, or, somewhere around there. But we don't know that for sure.
One of the new things of social media is wonderful people. There's a guy named Triple Net Investor that's out there reviewing empty office buildings trading for next to nothing. Right. I got good news. Philadelphia is not on the latest list of this city, that city, and the other city. From where you stand and from all your contacts, and Philadelphia's led on this, where are we on the washout and cleanout of commercial real estate?
Again, commercial real estate isn't a one-size-fits-all thing. So downtown office is what we're talking about. The dentist in the suburban office mall is doing just fine, right? It's that downtown office space. We are starting to see that clean out some. Again, it's going to take some time. Whether it's new businesses moving into that space at much lower rents or conversion. We're seeing a lot of conversion activity as well.
Do you have a confidence that the banking industry is resilient to that conversion?
So far, yes, I do. But it's something we clearly need to keep our eye on.
Well, sticking with real estate, let's talk about the residential side. You were optimistic at the start of the interview here, talking about mortgages coming back. There's been a lot of criticism of the Fed maybe breaking the mortgage market because interest rates rose above what the majority of people had for their mortgage rate. Do you have an idea of what level housing it takes for housing to come back? And does that figure into your calculations of where neutral should be?
Yeah, so we had to do what we did to get inflation under control. So no apologies that we took rates up quickly. I think about my generation, the baby boomers, the largest generation to go into retirement. We're sitting on these low mortgages. We want to move. We don't want that big house anymore. That lock-in effect, it will start to ease as rates come down. And we're already starting to see a little bit of that. Again, I talked to the bankers, they're writing mortgages again, not just refis, but they're writing new mortgages again. That combined with the new supply that'll come on the market, I'm pretty optimistic that we can get there.
This is a critical statement from Mr. Harker. The idea of, when the rate comes down, where does the fever step in again? Are you looking in Jackson?
It would take a lot.
It would take a lot.
It would take a lot for that to happen. Another question that comes up now that you're essentially starting the path to rate cuts is, what do you do about the balance sheet? Because in theory, they